Thank you very much, Jen, and a very, very good morning from the lovely sunny Surrey countryside. We had a bit of sleet and snow early last week, and looking forward to bask in the sunshine over the Easter weekend. And that is how tax works. Change, more change, oh dear. But it's good to embrace this change. What is this change? Well, it will affect how profits are taxed for unincorporated businesses. The legislative background behind this is as follows. These proposals were initially laid out by the government on the 23rd of March 2021 through the Tax Administration and Framework Review. And then came Legislation Day, otherwise known as L Day, on the 20th of July last year, with the government publishing the Draft Finance Bill 2021-22. As always, the government had to do a consultation on these proposals, which then closed on the 31st of August 2021, and the rules are now embedded in the Finance Act 2022, which received royal assent on the 24th of February 2022. So, ladies and gentlemen, these rules are now here with us to stay. The new rules take effect from 6th of April 2024, that is, the tax year 2024-25, with the tax year 2023-24 being the transitional year. Now, in the initial rules, they were supposed to take effect from 6th of April 2023, i.e. the tax year 2023-24. However, we've now got a year of deferral, which is great as we can all plan ahead. Death, taxes, and childbirth. There's never any convenient time for any of them. So why bring about these changes? The aim of the reform to basis periods rules is to make the basic assessment for trading profits a lot simpler. Simpler, we shall see, and more aligned with other sources of income, which then link in with the government's plans for MTD. Now, if you note your other sources of income, example, bank interest, dividends, employment income, they're all taxed based on the tax year. It therefore makes sense to also have profits for self-employment to also be taxed in a similar manner, i.e. per the tax year. As my colleague Emily Baldwin has just alluded, making tax digital, MTD, becomes mandatory for self-employed businesses from April 2024. MTD will also apply to unincorporated businesses and landlords with annual income exceeding £10,000. And it is intended that MTD rules will also apply to partnerships that only have individuals as partners and trusts with business or property income. Now, these proposals are to enable a tax system from the ancient 19th century to be shoehorned into the digital requirements of the 21st century. Albert Einstein said, "The hardest thing in the world is to understand the income tax." Before we jump off onto the rules and changes in the rules, it's important to understand what the current rules are. Now, for all unincorporated businesses, such as sole traders, partnerships, and LLPs, the basis period for a tax year is the 12 months ending with the accounting date in that tax year. For example, a partnership's trading profits for the year ended 30th of April 2021 will get assessed in the tax year 2021-22, as its accounting date, that is 30th April 2021, falls in the tax year 21-22, in between 6th of April 21 and 5th of April 22. And the authority for this is in Chapter 15, Part 2 of the Income Tax, Trading and Other Income Act 2005. Therefore, from a practical perspective, a partner will not pay tax on his profits accrued to 30th April 2021 until, say, 31st of January 2023. So you can see a real mismatch in the time frame when the profits are earned or accrued and when they are taxed. Also, you have between 30th of April 2021 and 5th of April 2022 to prepare the accounts, get them finalized and signed off, consider tax planning strategies during the tax year, for example, pension planning, investments in venture capital trusts or enterprise investment schemes, etc., etc., to mitigate some of the income tax liabilities. There are special rules for the opening and closing years of a business and when there's a change in the accounting period end. The current rules in the early years of a business or when a partner gets appointed to a partnership can create overlapping basis periods, which results in profits being taxed twice, which then creates overlap relief, which is usually given on cessation of the business or when a partner retires. So, as you will see, what's the main change from the 6th of April 2024? The key reforms involve moving from the current year basis to a tax year basis, meaning that business profits will be calculated for the tax year rather than for the period of account, i.e. their accounting year end. These changes apply to all sole traders, partnerships, and LLPs. This would align the treatment of trading income with other non-trading income. Now, the tax year basis periods will require businesses to report for the period from the 6th of April to the 5th of April tax year for trading purposes, regardless of their actual period of account. Businesses with non-tax year periods of account will be required to apportion profits and losses across the periods of account to adjust their results to the tax year basis. Now, this sounds complicated in the way it is, but I'll run through some examples as we go along to understand it better. For any periods where the accounts are not yet finalized, the apportionment will require a degree of estimation and subsequent finalization. Trading and property businesses can treat an accounting date of between 31st March and 4th of April inclusive as being equivalent to ending at the end of the tax year, that is 5th of April. And so those businesses would not have to make the small apportionments of profits. Let's look at an example. Now, look at a business who makes up their accounts to 30th of April. Currently, the profits for the year ended 30th of April 2021 will get assessed in the tax year 2021-22. With a change taking effect from the tax year 2024-25, it will need to include the results to determine the taxable profits for the tax year 24-25 as follows. 1 month, and that is 1/12 of the results for the year ended 30th April 2024, and then 11 months, that is 11/12 of the results for the year ended 30th April 2025. Now, noting that the 2024-25 tax return will need to be submitted to HMRC by no later than 31st January 2026, the accounts for the year ended 30th April 2025 will need to be finalized by then. Otherwise, the 2024-25 tax return will contain estimated figures, which will require amendment once the accounts for the year ended 30th April 2025 are finalized. if we just go back to the slide before, please. Now, if you look at that main change, now looking at that year ended 30th April 2021, the profit started to accrue from the 1st of May 2020. However, that profit does not get taxed until 31st of January 2023. Now you can see the time lag there, and that is the time lag that the government wishes to eliminate. If we move on to example 2 now, please. Let's look at a business who makes up their accounts to the 30th of June. So, under current rules, the profits for the year ended 30th of June 2021 will get assessed in the tax year 2021-22. However, with a change taking effect from the tax year 2024-25, it will need to include the following results to determine the taxable profits for the tax year 2024-25. Firstly, 3 months, i.e. 3/12 of the results for the year ended 30th of June 2024. That's April, May, and June 2024. And then 9 months, i.e. 9/12 of the results for the year ended 30th June 2025. Noting that the 2024-25 tax return will need to be submitted to HMRC by no later than 31st of January 2026, the accounts for the year ended 30th June 2025 will need to be finalised by then. Otherwise, your 24-25 tax return will contain estimated figures, which will require amendment once the accounts for the year ended 30th June 2025 are finalised. Now, I will go and demonstrate how the problem actually gets worse for businesses which use accounting dates from 30th of September to 30th of March. Today, it takes more brains and effort to make out the income tax form than it does to make the income. So let's look at a business who makes up their accounts to 31st of December. Under current rules, the profits for the year ended 31st December 2021 will get taxed or assessed in the tax year 2021-22. However, with a change looming ahead of us, for the tax year 2024-25, that business will need to include the following results to determine the taxable profit for the tax year 24-25. So 9 months, that is 9/12 of the results for the year ended 31st of December 2024, and 3 months, that is 3/12 of the results for the year ended 31st of December 2025. Now, noting that the 24-25 tax return will need to be submitted to HMRC by 31st of January 2026, the accounts for the year ended 31st of December 2025 will need to be finalised by then. That only gives you 1 month after that year end, which makes it very difficult and perhaps impossible. Therefore, the 24-25 tax return will contain estimated figures, which will require amendment once the accounts for the year ended 31st of December 2025 are finalised. Now, this poses a real challenge to many businesses. If we look at the next example, and which will illustrate a classic issue with estimation. So let's fast forward ourselves to September 2025, and a sole trader or a partnership has just signed off their accounts up to 31st of December 2024, which shows a taxable profit of £110,000. But we now have 4 months to 31st of January 2026, i.e. the deadline to submit the sole trader or the partnership's 24-25 tax return. Now, let's assume the business did not have a good start to 2025. and that its management accounts showed a taxable profit of £15,000 for the first 3 months, that is January, February, and March 2025. So the 24-25 tax return will show the following results. 9 months, i.e. 9/12ths of the results for the year ended 31st of December 2024. That is 9/12ths of £110,000, and that gives you £82,500. And then we take 3 months, i.e. 3 months for the results for the year ended 31st of December 2025, estimating this from the management accounts at £15,000. Therefore, that business submit their tax return for 24-25 tax year by 31st of January 2026, based on a total taxable but provisional profit of £97,500. Now, once the accounts for the year ended 31st of December 2025 have been finalised, it transpires that that business was rather innovative through the year and established other avenues of revenue generation, which boosted their profitability. The final accounts for the year ended 2025, which are then signed off in September 2026, show a taxable profit of £170,000. So we now need to go and revisit the tax return for 2024-25. And this is what happens. The initial tax return obviously showed a taxable profit of £97,500. But now you will have a revised taxable profit of £125,000. That is £82,500 for the 9 months for the year ended 31st of December 2024, and 3/12ths of £170,000. The result of this, as you will see, is a loss of their personal allowance, a marked increase in their income tax charge, and then interest on underpaid tax. Problems with estimation. There are additional administrative issues caused by estimation, such as you submit a tax return on an estimated basis and then follow up with amendments when the figures are finalized. 2 lots of tax returns. Possibly drastic differences in tax outcomes. Interest charges on underpaid tax. John Maynard Keynes said, "The avoidance of taxes is the only intellectual pursuit that actually carries any reward." HMRC have suggested some options as administrative easements to minimize the burden caused by having to submit tax returns that contain provisional figures. And it will consult with stakeholders ahead of the transitional year in respect of the following options. Allow taxpayers to amend a provisional figure at the same time as they file their return for the following year. Allowing extension of the filing deadline for some groups of taxpayers, such as more complex partnerships or seasonal trades. Allowing taxpayers to include in the next year's tax return any differences between provisional and actual figures in the previous year. Or leaving the current rules on provisional figures unchanged, whereby the profits can be estimated in a return and amended as soon as the final figures become available. The next major change, phasing out of overlap profits. As I mentioned earlier, commencement, cessation, and changes of accounting dates will no longer require the complex opening year and cessation rules, as the relevant periods will simply run to and from the end of the tax years respectively. So this will eliminate all overlap profits and the need for overlap relief in the years after these changes come in. And so therefore, no further overlap profit will be allowed to be created, or therefore no overlap relief will be allowed to be created, or used for that matter. However, the proposed transitional arrangements do provide for the use of the existing overlap relief. So you've got to use up and exhaust the overlap relief in the transitional year 2023-24, or else they get wasted. Now, we've got this tax year 2023-24, which is known as the transitional year. In that year, continuing businesses will be taxable on following profits. Their profits on the current year basis, i.e. for the 12 months to their accounting date, which falls in the tax year 23-24, plus profits which arise in the period from the day after the current year basis period to 5th of April 2024. And depending on the accounting date of the business, as you will see shortly, this could potentially bring almost up to 2 years of profits into charge for this year. We look at an example to demonstrate this. A business with accounts made up to 30th of April. Currently, the profits for the year ended 30th of April 2021 will get assessed in the tax year 2021-22. However, it will need to include the following results to determine the taxable profit for the transitional year 2023-24. Results for the year ended 30th of April 2023, and that's a full 12 months, plus results from 1st of May 2023 to 31st of March 2024. Therefore, 11 months, or 11/12ths, of the results for the year ended 30th April 2024. As you see here, 23 months of profit being taxed in the transitional year 2023-24. Therefore, businesses with 30th April year ends could be particularly impacted by this change. It can lead to a significantly increased tax bill. And in the transitional year, as I explained earlier, all overlap relief brought forward must be used. And in subsequent years, no further overlap relief can be created. The transition profits after the offset of overlap relief can be spread over a period of 5 tax years to mitigate the cash flow impacts. Individuals can elect to be taxed on the full amount in the year of transition. An election can also be made for the additional profit allocation to kick in at any point during the spreading period of 5 years, and this must be done within 12 months of the self-assessment filing date for the tax year in which the taxpayer wishes to recognize the additional profits. The transition profits will be treated as a separate one-off item of taxable income, which is excluded from the net income at step 2, with the equivalent tax on that income being brought into charge at step 7 of the income tax calculation. A lot of jargon, but what does this mean? The transitional profit will create a standalone tax charge, and in so doing, it will not affect the level of taxpayers' income that is used to calculate things like the entitlement to relief on pension contributions and child benefit. It will also be possible to claim double tax relief where relevant. For example, credit can be claimed for overseas taxes suffered on foreign profits arising in the transitional period. An individual will also be able to claim income tax relief for relevant investments. Example, enterprise investment schemes, seed enterprise investment schemes, venture capital trust investments, against the standalone tax amount as well as their other income in that year. Now, as per the draft legislation, the initial rules penalised a business if it changed its accounting date in the transitional year. It could then not spread any transitional profits arising in that year. However, this has now been resolved in the Finance Act, and businesses will be allowed to change their accounting date in the transitional year and be able to spread the transitional profits over the 5 years. And as you will see, a number of businesses will be considering a possible change in the accounting year-end date. If a loss arises in the transitional year, then the taxpayer will be able to treat the business as ceasing on the 5th of April 2024 for the purposes of terminal loss relief rules. This means that this loss can be carried back for up to 3 years rather than just the standard 12 months to have set against profits taxed in those years. What are the practical impacts or consequences of these changes? Well, in the short term, while the rules may simplify certain technical and practical matters, firms that do not make their accounts to 31st of March or 5th of April will need to consider the impact of the proposed changes on their cash flow, particularly for the transitional year 2023-24, which could see partners paying tax on significantly increased amount of profit. The impacts will continue to be felt going forward as those changes close the timing gap between the profits accruing and being brought into charge for tax. These changes may be particularly challenging for large professional services firms with complex financial and tax affairs, and their impacts will need to be carefully considered and prepared for ahead of the transitional year. The 1-year deferral is welcome, but businesses would be well advised to make sure they make best use of the extra time available. In the long term, the reforms may move or remove some of the cash flow advantages through operating through a partnership model and make it harder for partnerships to finance their working capital. It is possible that some firms will want to consider the pros and cons of moving to a corporate structure in due course. The ongoing requirement to apportion and or estimate profits of consecutive accounting periods may lead many businesses to consider changing their accounting date to align with the tax year, for example, 31st of March or 5th of April. What if the business or the partnership does not have sufficient profits in the transitional year to utilize the previously created overlap relief? That overlap relief then goes wasted. Some international partnerships may have a preference for a 31st December accounting date due to tax rules in other countries, example, the United States. On that note, the Office of Tax Simplification is currently evaluating the pros and cons of changing the UK's tax year end to either 31st of March or 31st of December. The latter, 31st of December, being considered the more radical option, but acknowledging that there may be benefits in aligning the UK with the majority of the international tax regimes. Winston Churchill said, "We contend that for a nation to try to tax itself into prosperity is like a man standing in a bucket and trying to lift himself up by the handle." With this, ladies and gentlemen, I now rest my case.